All right, good evening, peeps. How are we? How is everybody doing? All right, just let me know if you can hear me okay. I've got the chat up here. I know that there's already a question in here as well. Thanks for joining me, by the way. Um, Normal Q&A, really. There's a lot of stuff going on at the minute in the market, so I do just want to touch on maybe just a topic that I think is going to be important, and that is 5 by 5. Good, perfect. Cheers. Um, yeah, I just want to talk a little bit about sort of the market and everything that's going on at the minute. If you're following stocks, you would have heard. I think who was it called? It was a stock that on Friday took an absolute hammering. I posted about this on Friday, and the comment that I got back kind of didn't alarm me or anything. I don't want to say it alarmed me, but it made me sit up and pay attention to something specifically. So if you've been following DocuSign on Friday, their their stock price went from $234 to about $135 right now. So that's like $100 drop, right? Quite a big, significant drop. And I posted on stories. I just said, look, guys, obviously Kathy Wood was getting stick the entire day because she's got quite a large exposure to DocuSign, and I kind of said, look, make sure that you don't, buy a falling knife because effectively there's a lot of stuff going on at the moment with the markets. Obviously, Omicron, the whole inflation conversation at the moment, the whole debt ceiling in the United States. So I just wanted to talk about buying the dip a little bit this evening because I think it's really, really important to be mindful of when you should be buying the dip and be mindful that there seems to be this mantra or this, like, I guess, philosophy right now that you absolutely have to buy the dip 100% of the time, just go all in on the dip. And I think that's a little bit dangerous, a little bit. And I'll give you my reasons why. First and foremost, buying a dip is great if you know what stocks it is that you're buying and you've done your research. If you're being reactive through posts like watch this stock, it's down £100 today, and you just go buy it without any research, that's really, really dangerous. Because ultimately you don't know whether the stock is going to dive even further. You don't know where the bottom is. It might not be the bottom. And if you do buy it and it's not the bottom, are you completely okay with that? Particularly if you're buying individual stocks as well. So I think it's really, really important to kind of not get too excited about the whole, you know, everything's down right now. We need to go pile in. Yes, absolutely buy the dip, but please be responsible in doing that. Make sure that obviously you're doing your research. You're making sure that when you're buying these stocks and you're taking up positions, that it actually aligns with your goals. It aligns with your investment risk. It aligns with your overall plan. Really, really important. Because if it doesn't, and you're just buying stuff willy nilly just because a guy on YouTube says this stock is going to 20x or 5x or whatever it is that they talk about, you need to be a little bit careful. And that's kind of like my message, kind of like today. Guys, please be careful because there's a lot of volatility out there at the moment. So let's see what we've got. Naeem, thanks for being here, mate. I know that we've got a few questions in now. There was one that was put on before that I can't get up. So let's have a look. There were two questions. One, what are the best books for personal finance? Two, what are the best things to do when you retire to protect your investments, e.g., keeping 2 years worth of expenses in cash, etc. Um, Personal finance books, mate. There's quite a few. I mean, if you've not already read things like Richard Man in Babylon, that's kind of like a basic one. Very, very nice. Kind of like philosophies around money and just general finance in that book. Um, I've got a really good book that I've referenced to up here, How I Invest My Money. It's by financial services professionals. And it's interesting when you actually read the book, you get to see how they go about investing their money, having been in the industry. And all of these guys are investment professionals, how they invest their money. Surprise, surprise, a lot of them don't use or have large exposures to things like individual stocks. A lot of them have most of their money in things like ETFs, index funds, those kind of things. But another great thing in that book is that the balance that they try to strike between um, making sure that from a financial point of view, they're on a stable footing. So they put the foundations in place to make sure that they get the best financial position possible. And what I mean by that is, should they pay down their mortgage early, or are they happy having a mortgage? And that psychology around their train of thought. There were two or three people in that book that kind of have juxtapositions, and their rationale around it is very, very insightful. And it isn't to say that there is one right or wrong answer, because there isn't, but it's interesting to see how they rationalize their choices, particularly with the one where actually they say, you know what, we're going to allocate a lump sum, take a lump sum out, we're going to take it out of the market. Yes, we know it could grow at 10, 12, 15%, whatever it is that they're invested in, but we are going to pay off the mortgage because we want to have that peace of mind. That is very, very interesting. It's a really good read. It's called How I Invest My Money. If you're on my link in the video, it's part of the my recommended books, so you'll be able to pick it up there if you haven't already read it. In terms of part two, what are the best things to do um, when you retire to protect your investments? Um, I mean, you can take out 2 years worth of expenses. I know some advisors have done that as part of a strategy. They hold some cash back. Um, if you're actively using the money for income, then yeah, you're still going to have inflation, but it's not going to be that much of a problem, because hopefully you're siphoning off the money and replenishing the money on a yearly basis or every 2 years. Um, but if you are kind of like about to retire, you want to protect your money, I think one of the key things that you should probably be having a look at is if you haven't got anybody actually working with you to help you map your retirement income, you should definitely be thinking about trying to maybe move out of riskier assets into maybe more secure assets, or maybe income deriving assets as well, to help you with that income. But really, this is where a financial advisor would really add value for you, because you need that map, right? How would your income stream behave if markets were to do a -5, -6? How do you stress test that? A lot of them will do cash flow modeling. So they will give you a picture of your income for the next 15 to 20 years. So you know at any given time, if the market does this, you know what the contingency is. You know exactly what your picture's going to be like in terms of your income plan. They build that for you. So if you can't see a financial advisor, definitely have a look at maybe trying to reduce some of that investment risk, or take appropriate investment risk for you. But you could obviously put some cash that you're going to draw from for income purposes aside 2 years. I know that some people have done that as well. All right, okay, so let's catch up with the ones that I can put on screen. Thoughts on Lockheed Martin? It looks like a ball pennant, but I may be wrong. Not financial advice, I know. I make my own. With shorts behind up would be good part of living. I haven't followed Lockheed Martin, mate, to be honest. It's not one that I have in my portfolio. I don't necessarily invest in, because this is one of my one things. I don't invest in anything that um, is or can be included in the armaments type thing. That's just my philosophy as an investor. I don't have anything at all in armaments or anything like that. So Lockheed Martin, for me, that would fall into the armaments side. So I don't invest in that personally, so I can't really comment, mate. Heard that bank rates may change in February because of the Omicron variant. I heard on the Be Clever with your podcast. Thanks for connecting us. Users will be to his channel, by the way. No, Andy's great. Andy's really, really good. Interest rates won't increase just because of the Omicron variant. I mean, interest rates need to increase because of the inflation numbers. So I can't remember. I had a look at this the other day. UK inflation. Look at October. Yeah, the inflation numbers was 4.2 in October. We haven't got November's numbers out just yet. But if you think about the fact that the Bank of England tries to keep the inflation numbers at 2%, we're currently running at 4.2, so that's double. And we can see this in gas prices, fuel prices, and just the general cost of things going up around us. They need to do something to bring everything else in kilter. And the way they will be able to do that to counteract this inflation is increase interest rates. So it won't just increase because of the Omicron virus variant, it will be because of the high rate of inflation currently. But it is set to increase. It may even increase a little bit sooner than that, but yeah, it is definitely set to increase. I think the inflation forecast for like April is like 5%, and we're not too far off that right now. So, depending on what the numbers look like in November, if it's come down slightly, great, but they're forecasting 5%. If we're higher than what we're in November than November, in higher than October in November, then I wouldn't be surprised if they actually forecast a little bit more. But yeah, bank rate will definitely increase now, which is why you started to see things like the 40-year mortgage propositions come in, and an actual product that will offer a 40-year fixed rate mortgage. Now, for many people, that will be like, oh my God, that's a very, very long time. But the average mortgage rate here in the UK is probably about 30, 35 years anyway. So be able to fix it in for that length of time it's an interesting product, but I'm still a little bit skeptical around whether or not they're going to have things like, charges, penalties to get out of the contract. It's going to be interesting to see. But with these kind of situations, innovation will always come along. I'm not sure that 40-year fixed rate mortgages is innovative in its own right. I mean, the Americans have been doing this for years and years and years. We just have a habit here in the UK of taking out 2 to 5 year fixed rate mortgages in the whole, and then rebrokering and remortgaging every 2 or 5 years because our rates have been historically high. We haven't been at this level of interest rate before. What do you think about Chinese stocks, more specifically the two, Alibaba and Tencent? They are both down in double-digit percentages, so now would be a good time to buy if bullish on them long term. Alibaba, I mean, Jack Ma has gone missing for a very long time, and it feels like ever since he's gone missing, the share price has suffered massively. Tencent probably, maybe, in my opinion, if I had to buy one of them, I'll probably buy Tencent. I don't hold either of them right now. But Alibaba, I personally wouldn't touch that for the time being. It's been on a downward spiral for some time now, and nobody knows where Jack Ma is. Nobody knows where he is. Like, where is he? And it just demonstrates that the Chinese government is very, very authoritarian in that way. Alibaba. If you're doing your research and you think it's a good buy, then by all means, take a punt on it. But it's definitely not one that I would have in my portfolio at this point in time. Will you hold it long term? I personally wouldn't hold it long term, but then you've got your own research, you've got your own convictions around how it fits in your portfolio, how it gets you further down the line to your investment goals, I guess. If you're happy to square off all of those questions with concrete answers and a conviction, then by all means. But yeah, it's not. I don't hold either of those at the moment in my portfolio. That doesn't mean that I haven't got them in index funds though, because a lot of my money's in index funds, so I do have a little bit of exposure to China, but I don't hold any individual Chinese stocks apart from NEO. I think. Just trying to think now what I've actually got. NEO, I've definitely got. Have I got? I think I've got one other one, which is semiconductors as well. And the semiconductor side is actually very interesting because of the whole shortage. So I think a lot of companies in that space are going to do very, very well, particularly with the whole metaverse side of things as well. So I think there may be a little bit of growth long term in that area if they're producing chips. Um, yeah, definitely. And I think Tencent, I'm pretty sure Tencent are part of those. Tencent are in a lot of the top 10% holdings of a lot of these funds. They're in a lot of funds. Even if you go on Vanguard, you'll find Tencent in the top 10 holdings. But I don't hold that stock individually. David, all right, okay. Is there any way legally to buy a property for a child? It's something we have thought about for a while. For instance, my son is 9. Can we buy property for him now for the future? Um, no, there is no way that I know that you could buy property for a child now, um, especially if he's 9. Um, there's nothing that springs to mind, mate. Yeah, there's nothing that springs to mind for a child at 9 years old. I'm guessing is I'm guessing, and I could be wrong, mate. I'm guessing you probably have a lot of cash just there that you need to utilize. Um, I'll probably give you one thing to maybe think about. And I don't know your circumstances, so this may or may not work. But what a lot of wealthy people will do is they will buy property in special purpose vehicles, so limited companies and so, because then it becomes easier for you to pass it down to children. So obviously, a property will be within your estate. So if you're married and you're over the nil rate band and the resident nil rate band of £1 million, if you pass anything on to your kids, then they have to pay 40% on the excess. If you put it into a special purpose vehicle or limited company, it's easier to pass it down to a kid, purely because what you then do is you make your son, when he's old enough, a director of the company. And because the company owns the property, he's able to then draw income from it and so on and so forth from it accordingly. It works better with buy to lets more than anything else. And again, I don't know your circumstances, so that may not necessarily work, but it's definitely something that I've seen clients do before, where they do have quite a few properties. They put it in limited companies owned by the company. They can make a child a director, take income, dividends, all that kind of stuff from it, and it's outside of your estate for inheritance tax plan because it's owned by a limited company. Um, but again, I don't know if that will work for you, mate. Um, if you're looking at doing that, I mean, have you had a look at maybe trust, allocating some money into trust, maybe that could be used for your son a bit later on in life? So you can set up a discretionary trust, for example, with a certain amount of money. You'll be the settler, obviously. Your son will be the beneficiary, and then you can have instructions on that trust for the money to be used for X purpose. You could use that. I'm just spitballing there, but I don't know your circumstances to be able to say for sure what would actually work for you, mate. Right, there's a follow up here, and this is about renting out. Um, Also, could we rent it out for him until he's old enough to take over himself and tuck the money away for him? So the question is, can't be done. Hope this makes sense. Yeah, I mean, if you can't, because you can't buy a property in a child's name, you can't do that. Um, the trust will probably be a good way to do it, mate. Put some money in a trust for him, so the money becomes available. So within the trust, it can be invested. Um, So you can invest the money within a trust. There's different vehicles that you could use for that. You could probably, I mean, you're not going to be able to acquire an asset like property as an asset, as far as I'm aware. Um, Not in my thinking. I've not seen it being done before. But you could put the money in a trust. The money will be invested for him until he's 18, and then you can transfer that to him, buy property, then obviously put a tenant in it for him. That's the only thing that I can think of, mate, at this point. Right, let's have a look at this from Bob. I recently started a Vanguard Life Strategy 80/20. Does it make sense to have a smaller amount go into S&P 500 as well, or is running two ETFs not a great idea? Um, I mean, there's nothing wrong with having both. just but within the life strategy, you're going to have S&P 500 in there anyway. So I mean, if you want more exposure to the S&P 500, then by all means, but you need to have a strategy behind what you're doing specifically. So I don't know what your time horizon is or your risk profile, but within the Vanguard S&P, the 80/20 strategy, you are going to have the S&P 500 ETF in there. You only have a portion of your money, obviously. So let me just go on here. Eighty-20. Right, might have to move my desktop around quickly. One sec, guys. Um, let's see what the makeup of this is. Share screen. Okay, cool. So you can see that. Let me just get rid of this quickly. All right, there we go. So you're going to have in here. There we go. So you've got access to the S&P 500 here in that 80/20, but this is going to give you more globally diversified options though. So you're going to have some bonds in there, right? Which you can see kind of like here. That's a bond. What else have you got in here in terms of bonds? You've also got, that's a bond as well. That's an investment grade bond here. Inflation-linked gilt. That's a government bond. Then the rest of it is basically just stock market, but it's more globally diverse. So you have got exposure to the S&P 500, but you've only got 5.5%. So if you wanted to go pick up, some further exposure to the S&P 500, you can. There's nothing wrong with you doing that. It just depends on how much exposure you want to those companies. But bearing in mind, if you have a look at the S&P 500 is down at the moment. It's a bit of a choppy time at the minute. Look at this. Let's look at that. Major indices. Yes, the S&P 500. It's down. I mean, it's had a bit of a rough week. But yeah, you can definitely go and get some S&P 500 as well as an individual holding if you wanted to for a certain amount of money on a monthly basis. Just make sure you're comfortable with how you're going to construct it so that it runs side by side. Right, let's have a look. Okay, so this one is saying, do I own China stock? If so, are you worried about recent actions on delisting companies and downturn of Alibaba stock? I don't own, apart from Neo, I don't own any other Chinese stock. Maybe 10%, but that will be within an index fund. I don't own any China stock or Chinese stock, as it were. But the delisting stuff has been on the radar now for like a year. Like they've signposted this for ages over in the States. So this isn't anything new. And like I said, with Alibaba, it feels like since Jack Ma disappeared, like the stock has been in a bit of trouble. But I don't have any Chinese stock at this point in time that I hold individually. If I hold it within an ETF, it will be within a researched, managed kind of like forum, because I don't have access to the kind of research that I know that my former colleagues in the investment house and discretionary fund managers would have access to. When I was working there, I would be able to see like what they get down every single day and get into a lot of information. I don't have access to that right now. So I'd rather just outsource that kind of stuff to somebody else to deal with it, because there's no way that I'm going to get the kind of data that the professionals do about China. And even when the professionals look at China, they approach China with a lot of depredation. Like they're really, really nervous. So they're overly cautious when approaching China. It doesn't mean that they always get it right, but they always take data that comes out of China with a pinch of salt. And because you're dealing with well, I was working with big investment houses. These guys will make demands for the money that they're investing. So if they're looking to invest, 300 million, 400 million into a company like Alibaba, you best believe they're sitting down with Jack Ma and the executive team there, because otherwise, they're not going to do it. They want reassurances around, control of the Chinese government over the company being a risk to their investment. So there's lots of stuff that goes into it. I don't hold any China stock individually apart from Neo. Um, and that was really just as a kind of like a very, very loose punt as a hedge, to see what happens with them and the Tesla participation in the Chinese market, essentially. But other than that, I don't have anything. Oh, cheers for that, mate. It's good to good to see that someone actually does get value out of it. Yeah, I do enjoy doing them, but it does take a little bit of time. But it's all good. Thank you, mate. How does someone check if they have a pension or access if they've worked at multiple places? Okay, mate, really good question. So, the best thing for you to do would be to use one of the providers who actually aggregate that information for you. So, I'm going to say Pension B here because I've used Pension B. Um, yeah, and I really like the guys over there. So, I'm a little bit biased if I'm completely honest, but they do a really, really good job. I transferred three of my old pensions, not last year, the year before, with them, and you literally just go onto their website, you fill in your details, and they literally just go off, go find it. They come back and say, "Look, we found this, 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 this. Do you want to transfer?" You confirm it, and off you go. Basically, the only thing that they can't do is they can't give you advice around the transfer. So, for example, if you've got like one of these old final salary kind of like defined benefit pensions, right? Where you have guaranteed minimums, like guaranteed income or guaranteed pension, they won't be able to transfer those. For that, you would have to go and see a financial advisor. But if you've got like a defined contribution where you know that there's been a certain amount contributed into your pension, that they can definitely deal with, but they can't give you advice. So they can just tell you we've got X amount here, and they will just transfer it for you, essentially. Really, really simple. You literally just go on. They need your name, your date of birth. They need to know roughly where you worked, the name of employer, and the period of time in which you worked for them, and your national insurance number. And I think that's about it. That's all they basically need from you. And they will just go off and do all the work. If you do want to use them, mate, it's very, very simple. There's a link. I think there's a link in my videos, right? I'm pretty sure there is. I'm pretty sure there is a link in the description of the video. So just check that out. But it's very, very simple. I'm just trying to find where I am, guys. One sec. Right, there I am. I like this. Any advice for 15-year-old trying to get into investing and business? Yeah, mate. Listen, you're 15 at the moment, so you've got time on your side. What I would suggest is, mate, just try and take as much information in as possible so that you understand and learn how the world of investing like really works. Like, if you can get your head around some of the investing principles, yeah, you've got 3 years before you can invest legally. So if you spend the next 3 years just really kind of like being studious and really, you know, understanding how investing works, you'll be off to a flyer when you can finally invest. And just be a little bit careful as well. Don't get investing and trading confused, because they're two different things, and they are they're conflated a lot. Like, investing is very much medium long term, and trading is, you're doing this on a day-to-day basis. And don't get caught up by the hype of people flashing watches and nice cars and holidays and all this kind of stuff trying to get you into like trading groups. Be very, very careful of that, and just be mindful that if they're promising you stuff that sounds a little bit too good to be true, or they're claiming things that sound too good to be true, it probably is. So just be mindful, but try and get yourself an education. You'll be absolutely fine, mate. So from Darren, if I want to invest actively in individual positions, is it best to practice? Is it best practice to concentrate on just having one active portfolio and the rest of my portfolio kept passively, i.e., ETFs, mutual funds? Um, When you say individual positions, I'm assuming you mean in individual stocks there, right? Can you just clarify that for me? Because then you go on to talk about active portfolios and the rest in passive. I mean, look, you can have both approaches. There's nothing wrong with that. The main thing for you to bear in mind is what allocation do you want in the active and what allocation do you want in passive? Because passive is great when the markets are going up. If markets are going up, it's fantastic. If markets are volatile or markets start to crash, passive is not where you want to be, mate. So having a combination of the both hopefully offsets, but at the same time there's an element of psychology here, right? Because if you have one in passive where you're paying very very little fees, and let's just say the market does crash, we see a minus 20 tomorrow, well, your passive is just going to dip immediately. And if you pick a really really good active manager, hopefully they will start making moves the minute the dip hits their tolerance levels. So a lot of them will have like targets and tolerance levels. And to be fair, they have to write to you if a dip, I think it's 10% losses, is what we used to call them. They have a 10% loss protocol. So if your portfolio dips below 10%, they have to write to you to let you know what's happening. But internally, as it approaches that 10% loss, they will start to pull levers and be like, okay, we need to have a look at rebalancing the portfolio to make sure that you don't sustain a huge loss. So the psychological bit there is, well, if you see a 20 to 30% dip in your passive and then your active is moving and flexing and you don't see that 20 30%, you might see a 10% loss, right? You're still both down, but are you going to be able to control the urge of cashing this passive pot in to put into the active? What I'm trying to say there is try and be as sure as possible. There's nothing wrong with doing both approaches, but just understand that both approaches will yield different results and they're going to act very, very differently. And from a investment point of view, if you're looking at it on a regular basis, particularly your passive one, you have to figure out how you're going to deal with that from a psychological point of view. I know it sounds very, very simple and nonchalant right now, but when you're in it, it's really hard. It's really, really hard because your natural fight or flight response kicks in naturally because you don't want to lose. You want to protect yourself from losing more money. So, a couple of things there just to bear in mind. Hey, nice to see you. Live, I started my ISA account on Trading 212 in February 2021, and you were one of the first YouTubers I watched. For more info on Trading 212, you made me more confident. Thank you. Thanks for that. Appreciate it. And yeah, thankfully, people find value from the channel. You know what? It's really, really nice to get that kind of feedback, and even on the podcast as well. Because yeah, a lot of the time I'm in here like creating videos and recording podcasts and doing stuff. So I'm kind of like in a bubble. And sometimes when I'm out and about, I will kind of like have people come up to me and be like, "Oh, watch the channel," and all that kind of stuff. And it's nice to kind of see the people that watch and actually put faces to names, if you will. So yeah, thanks for that. Okay, you're saying you invested only in dividend stocks right now. Okay, well, the great thing about dividend stocks is they'll be like large, most of them, I would imagine, well, will be large established businesses. So they will give you a little bit more security in terms of volatility. You'll still see it go up and down in terms of like the stock price, but because they're big companies that are obviously profitable, which is why they're able to pay dividends, it hopefully gives you a portfolio that is slightly more um, reliable and robust than just growth stocks, particular, and even maybe some of the tech stocks as well, outside of like Google, Facebook, and people like that. What's the maximum to reach before you pay tax on capital gains? Is 12,300. On this, by the way, I do actually need to have a chat about this. I have finally found an accountant that is going to be on the channel to talk about taxes and taxes on crypto specifically. I've been looking for months and months and months, and I spoke to one of my old colleagues from one of the investment houses that I used to work at, and he's put me in touch with someone at a national accountancy firm, and they're being very proactive in the crypto space. And I had a chat with him on Friday, and yeah, it is so nuanced, especially if you're staking. It's really nuanced. So I'm organizing with him. We've got dates down provisionally for him to come on, but because I go away on the 18th and I'm not back until the new year, we're likely going to have that content come out on the new year. So for him, I'm probably not going to do a live Q&A. Well, we can do a live Q&A, but I'm likely going to do like a full kind of like educational video. It might be a multi-part series, basically, where he will take you through income tax on crypto, capital gains on crypto, and all the other considerations as well. So I'm really excited about that. He's happy to come on a live Q&A just like this as well, but I think we'll get the video pieces done first and then the Q&A, so people get the chance to actually watch the videos, and then you can ask him questions. But he's been featured on Sky News, and he's been doing a lot of stuff in the tabloids recently, so he's a really good, very knowledgeable person who will be on in the new year around that tax piece on crypto. But yeah, finally found one, thankfully. All right. Right, there's a little bit more in here. I can't remember what your first question was. It was the retirement one, wasn't it? Okay, so where were we? Okay, so it's 37, basic rate taxpayer, have a DB for the last 10 years, want to retire at 60 as my mortgage will be gone. 50 to 60, I'm going to open a SIP and I won't be able to pay into my stock and shares ISA anymore. Okay, so you're 37 at the minute. If you've got a DB pension, first and foremost, you need to know what that DB pension is going to give you in terms of income. You need to know exactly what that's, because how do you know how much money you need to be putting aside in cash? How do you even know how much you're going to need in retirement? You know, what's your state pension going to be? There are so many moving parts within this planning piece here. So you need to know what's in your DB pension. You need to know what's going to be coming in terms of state pension, what your forecast is going to actually be. If you've got any other pension provisions, if you haven't already got one, I mean, you're saying from 50 to 60, you're going to open a SIP. I would argue you need to be doing that now, mate. Don't leave it until then. If you are not still with the company that is giving you this DB pension. Because if you have got this DB pension and that's going to be your main one, they're very rare now. I mean, even if I go back 10 years now, like it's very rare that you find a DB pension. You know, if you're not paying into that or contributing actively into a pension right now, then you should be, like, straight off the bat, because that time is your friend. You're going to have 23 years. 23 years. That's 2 decades. That's a lot of time. So you want to be moving on that now, but you do want, your pension, your state pension forecast, if it's going to be around at that point, because we don't know whether it will or not. You want to know what the DB pension is going to be kicking out. Then you can start thinking about, okay, so how much cash would you put across or put aside if you wanted to? And how do you actually then protect the amount that you've been able to amass? Your big ticket is the DB pension, mate. That's the big ticket. What is that going to give you in income? Because that's guaranteed for life, mate, and that will be inflation linked as well. So really, you want to start plowing as much as you can into that DB pension if you're still with that employer, to ensure that your DB pension is as big as possible. Right, where am I? I went straight up to the top to go and find your comment. So I just need to find where I was. Okay, so this is a question from Niam. You may have answered this question before, but I forgot the providers. What active money providers are currently present similar to Money Farm? So I think you've got Plum, you've got Wealthify. Those are the two that come to mind that do have an active management offering as well. So those two. I think this is a conversation going on between two people there. So AT&T is a really good stock for dividends. To be fair, they're probably one of the highest paying dividend companies out there. To be honest, um, so they are a good one to basically hold. I will put that up there, guys. Yes, please don't forget to smash the like button, please. That will help me out massively with the algorithm. Um, this is a really good question. What are my plans for the new year? I've got so many things that I want to do. It's time to do them all. Specifically for the channel, I've been thinking about. I wouldn't say I'm coming a little bit disillusioned or anything like that, but I'm just getting a little bit kind of like, I don't know. I feel like I'm adding to a lot of the noise in the investment space a lot of the time. There's a lot of hyperbole, and I don't like it. I really, really don't like it. Um, and like, because obviously this takes a lot of time to do, like shooting videos, editing videos, upload, keyword research, thumbnails, all that kind of stuff. I mean, I'll probably spend, more than I've spend about 3.5 days a week just on videos. And then with that, I also need to think about other things that I do. So the podcast, that's, a half a day right there, just organizing podcasts and stuff, editing podcasts, recording podcasts. So that takes me to 4 days. And that's, that gives me one day of the working week to do other things, which might be coaching and other things like that. And I just feel like the effort that goes into the videos, I was thinking about streamlining it in the new year, maybe going down to one video. But I don't know. I'm not really too sure at the moment. I think I might keep it at two. One of the things that I have kind of I tested maybe about 6 to 8 weeks ago, was maybe providing a little bit more news commentary. So talking about some of the financial news that's out on a day-to-day basis. Um, because breaking that down into simple English, I did did test very, very well when I tested it. But when I think about that, I'm also thinking about doing a newsletter as well. And that newsletter I'm proposing to do it weekly, but I'm still trying to figure out, and I've got meetings about this tomorrow, what format I put it in. So it's not just like an email that you get and it's boring. I want it to look different, and I want it to have really, really good content in there as well. So I'm thinking of obviously newsletter as well. That'll be a weekly one. With all this stuff, though, it requires me to allocate time, and if I don't have the time to do it, I've got to hire somebody to do it, um, and so that means capital outlay. So I need to weigh things up, because simply just on views alone on YouTube, the views alone don't make it worthwhile, and I don't do that many sponsorships on the channel. When I do sponsorships on the channel, I'm very, very picky about when I do them and who I do them with. But when I do, that's the only thing that really keeps the channel afloat, aside from, maybe corporate work that I will be doing, and a little bit of corporate work that I do anyway. So at the minute, I'm trying to find the balance between, I've got a ton of ideas that I want to do. So newsletter is something, but at the same time, it takes a financial outlay to be able to do that. So I'm going to be off between, the 18th and the new year. I've been working on a ton of stuff over the last month or so. I'll be tying that all together over the Christmas period, and then at that point decide, okay, from a time effort perspective, which is more efficient for me to do. I'm thinking it's probably going to be the newsletter. The newsletter is going to be called Elon's, because I love Elon Musk and obviously Tesla, my affinity with Tesla and stuff. So it's going to be called Elon's. So either be weekly or bi-monthly, so every 2 weeks. But yeah, I'm looking at the format right now. So if I can get the format right, then we'll press on with it, and that needs to be under different socials and stuff like that as well. So that's the plan for the new year. Hopefully, get a little bit more travel included within that as well. Maybe branch out with maybe some more feature stuff. We did test obviously the film on the channel. That went down really, really well. But the problem with the film is that costs money to produce. So that film that I posted on my birthday, that cost me two and a half grand to produce. And I think at the moment, if I look at AdSense, I think that right now has probably only earned something like, I don't know, 30 quid or something like that. So it's not a good return on investment. So I do want to branch out and do a little bit, more in terms of the different types of content. But time and effort is a really, really big element to that. So it's finding the balance between the two. But as and when I know what's going to happen and what I'm going to change and what is most efficient, I will definitely let you guys know so that you know kind of what to expect. But the content will be pretty much exactly the same. Yeah. So that video that I posted on my birthday, at the moment, if I look at the AdSense, it's earned £22.37. So for 2.5 grand, like, cost to shoot, from a business point of view, that makes no sense at all. And I can't, it makes no sense at all. But that was a passion piece for me, and it was testing for something else as well. So it makes it worthwhile. Yeah, someone's just saying there, get that compounding started now. Like, literally, time is really, really important. You want to get that going there. But if, like I said, with the DB is really where the cream is going to be. Like, really, really going to be, and the cream. What's a good percentage of income to pay into my pension? Right. Okay. So let's if you're working for a business, right, then your employer will have to pay in 3%. You have to pay in 5. So the mandatory minimum is 8% altogether. Um, so if you're able to pay in more, because a lot of employers will match you, so they'll say, we'll put in 3, you've got to put in 5, but if you put in 7, we'll also put in 7. So all of a sudden you've got 14%. So if you've got an employer that matches, and you just need to ask the question, do you match contributions with the pension at work? If they say yes, then you want to try and figure out what you can afford to pay in on a monthly basis to make sure that you get more money out of them. It's free money at the end of the day, guys. So if you don't take advantage of it, you're leaving money on the table. Like, and why? Why would you do that? It makes no sense at all. And for many people, that can make a huge, 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 huge difference. Someone's asking about Jivo stock. Haven't followed it. Not on my radar at all. Can I do a stock analysis? I can. I can do a stock analysis. I wouldn't do it right now though. Time wise, I mean, stock analysis. When I do stock analysis, so I used to do this in the Discord group that I had earlier this year, and we used to spend like an hour just going through some of the financials and stuff, and we'll spend an hour doing that. But it would take me another day or two just looking at the background of the business and just having a general look at what they're actually doing, competition, all that kind of stuff. Like analysis when you're analyzing a stock. Yes, you've got places like Simply Wall Street that aggregate a load of data into one simple format, but you still need to understand what it all means. And to be honest, I have used like Simply Wall Street, but one thing that you'll find is that because they're aggregating data from a load of different sources, you'll find in there, if you go onto like the news section, contradictory articles about the same company. So it's like they're correlating data, but some of the data may be contradictory. So I prefer to do it myself, so I can have a look at, right, who's the company, the team, the history, what their product is, whether they have any strategic advantage, then getting into their financials. Have they been around for a long time? Are they making profits? Are their sales increasing? What are their operating costs? Are they spending a load of money on advertising because they haven't got a strategic advantage? There's a ton of stuff that you have a look at: balance sheets, profits and loss. I have a look at a lot of stuff, and that takes time to be able to do that. And that's why, I have to stress to people that if you are going to be looking at buying like individual stocks, it's okay to use tools like Simply Wall Street and people like that. But for your own peace of mind, you kind of need to take that burden on yourself to make sure that you're 100% happy. So you're forming your own opinion before you put your hard-earned cash into something. So stock analysis takes time. I can do it, but it does take time. It really, really does. Is your investment course still available to purchase, and is it still up to date? What's the price again? It is still up to date. I mean, with the course for basics, essentially, it covers a lot of the foundational stuff around mindset, setting goals, investment time horizons. It talks about asset allocation, asset classes. So those basics aren't time sensitive, if you will. It tells you where to start. It is on the website for £59.99 plus VAT. For I think it's about £71.70 or something like that, inclusive of VAT. But yeah, there's a link in the description, or just conversationofmoney.com. You'll find it on the courses tab, but it is still there, and you'll be able to complete it in like 94 minutes. It's got tests and assessments in there as well. And when you do buy it, you've got access to a Discord group as well, so you can ask me questions afterwards as well after you've completed it. Do you recommend investing in gold, silver, physical royalties as an inflation hedge? Yeah, I mean you can do. I mean they are rare commodities and they have been a hedge against inflation historically. So yeah, I mean a lot of the investment houses that I know will hold gold, silver, and precious metals for a hedge against the inflation and also market dips as well. So you can. The question is how you're going to access it. Are you going to go buy physical gold? Or are you going to buy a gold ETF? That's going to be the main decision for you, mate. I think news videos will be really, really good. Just a quick 10 to 15 minute video every couple of days. Yeah, I mean that's what I tested. So, and they did really, really well as well. And what it does is by me doing kind of like the news videos, because I would do them live, I don't have to spend the time doing the edit. So all I have to do is basically prep the video and then do it live like I'm doing it now. I don't have to take it into post production where I'm very, very picky around. I want the videos to look great, so I do color grading and all of that kind of stuff, the sound tweaking, sound engineering. Like I won't have to do any of that. So it saves a little bit of time for me when it comes to putting videos out on a monthly basis, on a weekly basis. The only issue with that is obviously, and this is taking you behind the scenes of YouTube, um, live videos, oftentimes you can't really optimize them for maximum views and you can't also monetize them as well. So videos that are recorded and uploaded, I can choose, you know, if I want ads on them immediately. With a live video like this one right now, I can't have any ads on this. And by the time we finish this stream, by the time it's uploaded to YouTube, I'll probably have 800 or so views on it after everyone's kind of logged off. But I can't put ads on it to basically earn cash for the time that I spend answering these questions. So that's the only downside of the live side of things. And that's maybe something that YouTube needs to fix, but they just take ages. I think it takes like 24 hours before you can actually put ads into a live video after it's gone on. So it's one of those things where it's going to save me time, but at the same time, I won't be able to monetize the time that I put into creating that video to keep the channel sustainable. It's really, really interesting being here on YouTube. It really, really is. It's very, very eye opening. Yeah, and that's one of the reasons why I want to do it, because it can be quite complex. Like I talked about the bank rate increases and stuff like that, and the response for that was really, really good. And it actually did really, really well in terms of the analytics too. Oh, nice. I'm gonna watch news formats. That's good. This is good feedback, guys. I appreciate it. Thank you. Let's have a look at this one. Fabian, would you do a video about how to read company earnings? I'm quite curious to know what information you're looking for and how to use it for investing. I could, but you know what? In order for me to get the context right for it properly, it will probably be 30, 40 minutes long. And nobody is going to sit through that kind of video. Like literally, so I've been very, very conscious about making videos that are way long form. So I've been trying to get them down to like 12, 13 minutes, enough context, enough nuance in there so that people can kind of get the full picture. but the average viewage time on my videos is probably something like 3-4 minutes because people just turn off. And when I think about the time that it takes and the prep it's going to take for me to go through all of the analysis on video and actually prep that into an actual video without keeping it quick, snappy, which I want to provide context and content. There's so much content out here that there's not enough context to it. And especially if you're going to be looking at financial accounts and really analyzing that kind of company, you need to understand the context around it because there are so many things that come into it. To give a full explanation of that is like, it's like a classroom session on its own. And I don't see how I'm going to be able to put that into a video in a way that is, number one, going to be of interest and give me back the watchability time to make it worthwhile making that video, which is why I've toyed around with whether I do them as individual classes for a group of people. Maybe that's something that I would do, but then again, it's a question of, okay, so because the second course, the continuation course of the investment courses, has been in the works for a while now. I'm almost halfway through that. But part of me is like, well, it will take you through the next step around analyzing stock, the key things to watch out for, what actually moves a stock price, what are the macros that actually make that happen. That is halfway already built. But it's a course which has taken me at this point to get probably about 6 months to get to the point where it is. And it probably needs a few more little bits and pieces. I'm actually pulling in one of my old colleagues as well, who's an investment manager, into it as well, because he used to sit there all day analyzing stocks. So that is on its way in the new year. It just needs to be finished and completed. And I think that classroom setting is the best way to take that kind of information in with the context and being able to give you guys tools and methods of, actually, if you wanted to do this, this is how you can do it the long way or the short way, and providing that kind of context. And what age would you suggest is too late to start a pension, i.e., that person has missed their chance? I wouldn't. There isn't really, like, it's never too late, really, to be honest. As long as you've got some years left. I mean, look, my dad, he realized that he didn't have a pension at the point where he was going to retire. So, you need to start early. You need to start as early as possible. And even if you've got 2 years, 3 years, 4 years, you will thank yourself for investing for 2 to 3 years in the end, and that will give you a better result than if you did nothing at all. You know what I mean? It's like, trying to get on a journey of 100 miles and then you consistently just procrastinate and move your start date like every single week. All of a sudden, if you had started 2 weeks ago, you'd be 10 miles in. But because you procrastinated, you haven't made any progress. You're still in the same place, and now you have less time to get there. So start early, really, really start early, and it's never too late. It doesn't matter if you got a year or two, just make sure you've got a plan. It becomes more challenging, of course, but action is better than inaction. Making tax simple. Pension matching is so powerful. Also get the tax savings and putting into the employee scheme reduces your taxable income. And this is really true because you obviously getting the tax relief as well. People often don't realize that. Like, pensions is one of the most generous things that you have available at your disposal. They've just been they've been so misconstrued and taken the wrong way because they haven't been explained well in the past. Like, it's almost like it's been intentionally made to be confusing, because guess what? You got to go see a financial advisor, and a financial advisor will charge you, a few thousands to do work for you. It's not like that anymore. It really, really isn't. It's one of the most it's pretty much the only time you're going to get free money from the government and free money from your employer, like literally, because the government's going to top you up with the tax relief, and your employer has to pay in on your behalf as long as you opt in. Now, it's madness to opt out of a auto enrollment scheme, a workplace pension. It's absolute insanity. It's free money. Most people hate going to their job anyway. Most people hate their employer. Most people hate their boss. Why would you go to that job and not get their money? Of course you should. So it's, yeah, that's why I get so passionate about it. Like, I didn't always know about this kind of stuff until I started working in the industry, and it's like, oh my god, this thing is amazing. It's like, it's life changer. I'm now 18, incredibly intrigued about how to be the best with my income. What advice would you recommend, pal? You know what? Really good question. Look, the first thing you need to do, and I wish someone told me this when I was 18, right? So every single month, right, you got your money coming in. All you need to do, mate, is you literally just grab a sheet of A4, right? Draw a line down the middle, right? So just a line down the middle. You put all of your income on one side, expenditure on the other, and you tally up what you've got coming in, what you've got going out. And as long as you have some disposable income, take 10% of whatever you got disposable income and literally just throw that into an ISA or something, right? Throw it in, just forget it. Like, and it might be only 20 quid, it might be 50 quid, it might be 100 quid, whatever the amount is, put it into an ISA and just forget that it's there. Put it on direct debit or standing order so it goes out automatically every single month, and just continue to monitor what you've got coming in and what you've got going out. The biggest mistake most young people make, and I had a message actually about this on IG, it's from a 20-year-old wanting to buy a car, wanting to buy a 33 grand Mercedes. And I'm like, all right, listen, you've got to make your own choices and stuff. Mercedes is very, very nice, but 33 grand, what's that car going to cost you? And if it's going to cost you, I don't know, 300, 400 quid a month, could you do with a lesser car, still pay maybe 200 quid out for a car, but actually take that difference between the finance number for that nicer car that you're going to have and throw that into the stock market? It's like, what do you want to own? Do you want to own the stock or the car? The car will depreciate in value. The stock will increase in value. So if you go and buy, Mercedes stock or Daimler stock, that will appreciate in value more than the car that you're going to go buy. I say that to say this: don't feel the need to upgrade what you do at the expense of you being short-sighted, i.e., looking good and fitting in with the crowd and all that kind of stuff. Trust me, in hindsight, that stuff doesn't matter. And I can tell you this because I spent thousands upon thousands with, on a collection of trainers that I still have, hardly wear. For what? If I'd literally just gone and bought Nike stock, you know, or stock in, Louis Vuitton, LVMG, LVMH, I would have made way more money. But I didn't, because I was too interested in looking cool. I'd go and spend $1,000 on a pair of Balenciagas or Giuseppe's because it was cool. It's $1,000 down the pan. So look, control your income, control your expenses, and whatever you've got left over in disposable income, take 10% of that minimum, throw that into an investment, forget it. Make sure, obviously, that you get balance. So if you want to go on holidays and all that kind of stuff, I'm not saying scrimp so that you don't enjoy that kind of stuff. You can't go out with your mates, but just plan for it, budget for it. Give yourself an allocation, like an allowance every month. Be like, okay, I know I want to go out with my mates. I'm going to allocate X amount of pounds to go off and do that, and stick to it. It's all about discipline and habits, because that 10%, it might be 20 quid, 50 quid now, but trust me, in 10 years' time, when you're earning more money, that 20 quid is going to be 200 pounds. And then you're really talking with that compounding effect. That's where you're really, really going to start get going. So, yeah. General question. Doesn't need to be answered right away. Do you share the current pessimism regarding the economy, stocks, crypto? Everything has been going south for 3 weeks now. Listen, I wouldn't say I'm pessimistic about it, but I am I'm very pragmatic about it. For a lot of people who only just started investing over the last 12 to 48 months, right? They'll be in like a terrible place right now, because they've never really lived through or seen market dips and things consistently go down for like 3 weeks. Like, this is nothing. Like, this is nothing. And the reason why most people will feel like, oh my God, I wasn't expecting this, is because there is so much out here on TikTok, on YouTube. And again, I feel like sometimes I'm adding to the noise here. There's so much just misinformation and just clickbait, hyperbolic content about investing 10x, and this is the next stock for you to buy, without any appreciation or explanation of the risks and the fact that actually markets do go down. If you were around in 2007, 2008, this is a child's play. This is child's walk. This is nothing. Like, things back then dropped 51%. People lost their homes. People couldn't retire. People lost half their pension funds. Like, it's real. I remember that because I was in bank at that point, and I remember having to have conversations with people, and it's like, hold up, it's really, really difficult. So I don't have any pessimism about it. I expect it to happen. It's all part of the course, mate. In the end, long term, it's going to come good. But the reason why I always talk about, the fact that you need to have a goal, and you need to have a plan that is informed by your goal, and your plan and your goals will tell you whether you should be buying individual stocks or ETFs and index funds, is all because of scenarios like this, where stocks take a beating and it's hard to stomach. It's natural human instinct. Like, we all work really, really hard for our money, so we don't want to lose money. We feel scared when we're losing money. But the psychological triggers, how do you keep yourself sane? How do you keep yourself on course? You do that by having a very, very concrete goal at the outset and trying to get into that investor psychology. I have a whole chapter on that on my investment course. You have to anchor yourself in something that is tangible, in something that is intrinsic, so has internal value to you, not because of external factors. Really, really important. Like, I said this the other day. One of the biggest stocks, or the sexiest stocks last year, was Nikola, right? The EV truck company. Everyone was making videos about it, like, yo, this is the next stock. This is the Tesla killer, blah, 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 blah. What's happened to that stock now? Their CEO is likely going to get done for fraud because they basically lied. And the stock price has taken a beating. And it's all very well and good looking at stock price and looking at share price up here, then all of a sudden it comes down here. Real people lose money. And unfortunately, there would have been a lot of people that have been roped into buying that stock because of hyperbole on TikTok, YouTube, Instagram. Buy this stock, with no explanation of what the risks are. So I look at it from a pragmatic point of view. This is what happens, and a long-term view is really, really important. Is everyone entitled to state pension eventually? If not, then what else is out there for those who don't have a private pension? This is a really good question. So the current rules around your employer contributing into your pension was only brought in the last 10 years. And the reason why the government brought this in is because they want people to take ownership of their own retirement journeys, because we had a massive pension gap, like a pension funding gap, because everybody had this assumption, I can just get state pension. Now, the state pension, if you're looking at the new state pension, is only about 9,339 a year. It's nothing. Now, I don't know anyone who can live on £9,339 a year. I definitely couldn't. Now, how the state pension works is there isn't a pot of money that's there like an investment that then churns out that income. No. The state pension is paid for by people who are working right now. So the easiest way to explain this is you picture an ATM, right? Everyone who is retired right now is taking money out of this ATM, and that ATM is a state pension. So everyone who's retired is taking money out of this ATM right now, okay? Everyone who is working is at the back of the ATM, putting the money in for everyone at the front to be taking money out, right? Now, under the current circumstance, the rumor is state pension is not going to be around for much longer. There's a couple of reasons for that. Well, first and foremost, there aren't enough workers and tax take to sustain the amount of people that are taking money out right now, because people are living way, way longer. Remember, when state pension was introduced all the way back then, the life expectancy was something like 70. Life expectancy now for most people is 80, 90, even 100 years. You talk about people retiring at 65. That's potentially, if they live up to 100 years old, 35 years on state pension. And that has to be paid for by people working. You can get into, prime example, uh, driver shortage for delivering petrol. We don't have enough workers. So that's where you need migration of people to come over, work, pay taxes to sustain something like the state pension. Our population also isn't growing as quick as it was. So the whole point around state pension is, yes, at the moment you're entitled to it, but when you get round to the point where you want to take out money from this ATM at the front end, there may not be an ATM period, because the government will say, this is unsustainable. We've introduced legislation over the last 10, 20, 30 odd years to get people to take ownership. No more. The good news is, it will take a very brave politician or political party to basically scrap state pension. And I think that is the only shred of hope or beam of light that you have around the availability of the state pension later on. But I think it's inevitable. If they don't take it away completely, they will start to take away benefits like, triple lock is already come under fire anyway, where they'll increase your level of income that you get on the state pension in line with inflation. It's taken things like that, or they might just say, you know what, we're going to have to means test you. So, for example, if you've got a property of X amount of value and you've got equity in it, or you've got investments, or you've got savings, you can't have it. That's what's going to happen. That's where everything is heading to. And we've been saying this now in my industry for years. When auto enrollment and this whole legislation around the pension side of things came out, just under 10 years ago, we knew that this is what it was signposting to. But it's going to be interesting to see. Right, I'm just conscious of time, guys. There's quite a lot here, so I'm not going to be able to get to absolutely every single one of them. Apologies, but we've been on for an hour, 15 minutes, and I've got a really early start tomorrow morning as well. So, guys, thank you so much for watching, and thanks for some of the feedback that you've given as well around some of the news content. I will definitely take that into consideration over Christmas when I'm away. Over Christmas, there probably will be no videos from me at all from about the 18th of December onwards. You're probably going to see a video from me sometime in the new year. I don't know the dates just yet. We get back on when do we get back? We get back on the 3rd of January. So the 3rd of January is a Monday. There might be a video on like Tuesday the 4th. If not, it'll be Friday the 7th will be the first video, essentially. So yeah, there just won't be any videos from me necessarily, or any live sessions from me, because I am going to take the time off. Like, I've had no time off this year at all. So we go away on the 18th. We're back on the 3rd. So there'll be nothing from me in between that period of time. I might post in the community tabs or something like that. But yeah, just to let you know, it's going to be quiet because I'm not going to be producing videos or doing anything at all. I might get bored though, having said that though, because oftentimes I do. I get really, really bored and I'm like, I have to work. So yeah, you might see me, you might not, but I appreciate you joining me this evening, guys. Thank you so much. Have an amazing week, whatever it is that you do.